In this video, we'll further discuss asset allocation. This time, we'll dig deeper into asset classes and subclasses. We've already compared stocks and bonds, and we briefly talked about cash, but there are actually 6 different main asset classes, well now 7 if you include crypto. Remember that asset classes are investment groupings, typically based on how they behave, their risk profiles, volatility, how they are bought and sold, and the rules around them. So it's stocks, bonds, cash, then there's real estate, commodities, alternatives, and now there's crypto. We've already dedicated 2 videos for stocks and bonds, so just watch episodes 12 and 13. We know that the 2 form the primary mix for portfolios. Increasing your equity exposure tends to increase your risk in terms of portfolio volatility, but it also tends to increase your returns over time. Bonds serves as a dampener or our volatility control. The more bonds, the lower volatility, but it also dilutes our returns over time. Then there's cash and cash equivalents. It may seem unnecessary to talk about cash since it's so basic, right? But there's more to cash than the currency we hold in forms of bills or coins. Cash equivalents, money market instruments, near cash, all these mean the same for us. These are investable assets that are liquid enough to use short term, typically under a year. The most commonly used proxy for tracking cash is the 90-day treasury bill or the 91-day treasury bill issued by government treasuries. But there are also commercial papers or short-term notes. Think about them as really short-term bonds or IOUs with guaranteed maturity in a short window of time, and typically they don't have any coupons. Investors can hold cash as an emergency reserve or an opportunity fund, or maybe until you have enough to buy your next holding, your next investable asset, because sometimes you can't buy them in pieces. Maybe you're saving up to invest in the next venture and so on. Warren Buffett's Berkshire Hathaway is notorious for holding a lot of cash, using it for opportunities when people are fearful. The issue that I have with this when it comes to normal or regular investors is it sometimes switches over to market timing, and I don't like holding a lot of cash waiting for the market to dip because you might not actually do it. Chances are you won't. Next, there's real estate. Real estate is a bit of a challenge for people to grasp because it has hybrid components. It kind of behaves like equities, but at the same time kind of behaves like bonds or fixed income. See, when real estate appreciates, your equity, your ownership from the home grows too, right? Very similar to stocks. But if you have a rental property and you get rents, that cash flow behaves very much like fixed income instruments. So how do you classify it? It has to be separate because real estate has performed differently enough compared to other asset classes. The market for real estate isn't nearly as efficient as stocks or bonds, so price discovery is also happening in a different pace. For most people, they would just get an annual tax assessment, and that's the value they associate with their homes. Liquidity in equities is different when it comes to real estate, and depending on the type of deal you have, depending on the type of property you have, a deal can close within days, or in some cases months or years before the property is actually sold. With real estate, you can either own it directly by buying property or buildings, or you can buy REITs, real estate investment trusts, or even mutual funds now that buy real estate. I personally have a heavy tilt towards real estate in my personal portfolio simply because we've used leverage, but that's changing. I just think it helps to disclose that because as advisors, we need to be able to look at your wealth building journey, not just from the assets we manage. There's other components of investing or growing your net worth beyond stocks and bonds. The next class are commodities. Commodities are typically items or goods with utility. Think oil, gold, silver, lumber, cotton, copper, and lithium. These are not companies. They are raw materials or goods that companies or people would need or maybe want to create something. One of the most studied financial bubbles is the tulip mania, where people were selling or buying tulips. They essentially traded tulips. Today, you buy commodities through securitized forms. They're either futures or forward contracts. Essentially, investors don't buy the goods. They buy and sell the rights to deal at a certain price. When you look up oil, you'll either see pricing in WTI or Brent crude. That price reflects how much a barrel of oil is going to be priced in next month's delivery. On a small scale, you might hold a few pieces of gold, maybe a few bars, but you can also buy through securities. Now, just like real estate, commodities have a different behavior and different return profiles compared to stocks and bonds. Gold, for example, has been called the safe haven because whenever there's extended periods of volatility, people tend to flee equities and they go to gold. I'm not saying that's a good idea or a bad idea. That's just something that people have done and continue to do. During times of uncertainty, gold tends to hold its value better than stocks. Sometimes it even appreciates because there's other uses for it. Think, like I said, utility, right? Like what else can it be used for? Not just speculation. One thing you might understand now is the boom in electrification or cars becoming electric. That's increased the demand for lithium and copper. So some commodities become investable from their inherent market need, not speculation. Next, there are alternatives. Assets that don't quite fit as nicely inside other asset classes would go under alternatives. These would be private equities, hedge funds, venture capital funds, and so on. Depending on who you ask, they may only really look at 3 asset classes: cash, bonds, and equities. Everything else they lump into the alternative, but that doesn't really matter to you. What you need to understand is that there are different ways to group where you're investing in to easily characterize asset behavior. You can also learn how assets behave against one another through different market cycles. That's why it's important to kind of understand how asset classes work with or against other options. Lastly, there's crypto. I wasn't even really sure if I should put this on here. Cryptocurrencies such as Bitcoin, Ethereum, and Dogecoin, and so on have definitely performed differently than other assets. The reason why I decided to put this in here though is that you should understand that you might be one of those people that have heavily tilted towards crypto. There are other things that you need to consider. It might be a good time to understand other asset classes and diversify away from it. Or if you're entertaining the idea of investing in crypto, just understand that you should still look at your whole portfolio as a group of investments. Don't just lump everything into crypto or Doge or whatever the newer ones are that seems like they're coming out every day. Now, for many of you, everything that I just discussed is good to know and understand, but you may have no need to implement or act on any of them. You may be able to reach your goals simply by creating a blend of cash, equities, and fixed income, leaving out all the other classes altogether. But you also might be one of the people who have been fund collectors, unknowingly investing in different funds or purchasing them without really understanding what you're investing in or what's inside the funds as they were being pitched to you. So how can you slice up asset classification? Now, when you look at real estate, you would have 2 subcategories, right? There's residential and then there's commercial. That's our first layer of subclassification. Now you can go deeper. Within residential, there are single family homes, then there are duplexes, then there are townhomes, and there are condos. In a single family home, you can then subdivide that further. You can have bungalows, 2-story, split level construction, and so on. And then after that, you can add another layer of grouping. You can break it up into those with attached garages, detached garages, or no garages. So you can add additional filters to break them up. All of these can be a way to build a real estate portfolio. I mean, they're all buildings, yes, but just consider the insane real estate market we've been through in Canada. The average prices in residential properties have gone up on average 20 to 30% over 2020. But that was for single family homes. In Calgary, for example, I was eyeing a few condo units where the price was actually coming down as people wanted to leave downtown condos and get more privacy and get more space, and they were going to the suburban neighborhoods. So just because you own real estate, your risk profile or your investment profile is not going to be the same. It's all going to depend on what kind of real estate you actually own. So let's subdivide equities now. For equities, you can divide your position geographically because Canada only accounts for 3% of the world's economy and its equity markets. It's probably wise to invest elsewhere. There may be periods of time where the Canadian economy performs poorly while other nations have a bustling activity in their economy. Developed economies also have lower expected growth rates compared to developing countries such as the BRICS, Brazil, Russia, India, China, and South Africa. I haven't used that terminology in a while. An investor with a higher risk tolerance and a higher desire for equity growth could consider allocating some of their portfolio's equity towards the emerging or frontier markets. They can also be subsegmented based on market cap or how big the companies are, the total market value for the company. Let's look at capitalization breakdown in the US, for example. There's the US large cap stock. In the US, there are companies with valuations over 10 billion, while mid cap companies would have valuations between 2 billion and 10 billion, small cap between 300 million and $2 billion. Anything under that is called micro cap. Even though these are all stocks, holding a portfolio with large cap would behave differently when compared to a mid cap or a small cap or even a micro cap portfolio concentration. Small cap stocks tend to have a higher return compared to large cap, but it also has higher volatility or higher risk compared to the large cap asset class. So you can start with a 70-30 portfolio, for example, but diving deeper, you can subdivide the 70% into 30% equities in Canada, 20% in the US, and 20% international, and so on to diversify further. And then within each geographic breakdown, you can then think about the capitalization of the assets that you hold. I'm not saying that's what you should do. I'm just saying that that's how you can kind of start tearing them down as you build your equity portfolio. Now let's look at bonds and subdivide them. Bonds can be grouped into, first, the term to maturity. So we can be looking at short-term, intermediate, and long-term groupings. Within each term to maturity, then we can break that down into two different subclasses, depending on the issuer. We can look at government bonds, and then there's the corporate bonds. Even though these can share the same characteristics, government bonds are considered safer since they can just turn up the tax so that they can pay their debts and overspending. Typically, though, the higher level of government that's issuing the instrument, they lower the interest rate because tend to be safer compared to municipal bonds or local cities. Corporations, on the other hand, must pay their obligations from future earnings, which may not be there. So given the same term to maturity, corporate bonds have a higher risk compared to the government bonds, so they would pay a higher interest rate or a risk premium. Bonds can then be grouped by their credit or corporate credit worthiness, the credit score. We've already talked about that before. There are two primary credit rating agencies, Moody's and Standard & Poor's. Here's a summary of their credit rating spectrum. Higher credit ratings, just triple A's, are considered safer, are known as investment grade bonds, while bonds with a double B or a BA from Moody's are considered junk bonds. So within bond investing, you have different methods of dialing up or dialing down risk. So you might see a fund in your RSP or your TFSA that says short-term bond or long-term bond. Now you know a little bit more about that. Soon, we'll talk about funds and products that you would actually buy so that you can invest and participate in these asset classes. But what good are asset allocations gonna do for you if you can't hold that strategically long-term or implement it over the long term? In tomorrow's video, we're gonna talk about rebalancing and making sure your portfolio matches your intended asset allocation as time goes on. Until then, stay aware, take control. I love y'all. Bye. Watch the full playlist here. If you haven't seen any of the videos, you can subscribe here or watch yesterday's video.